Guys, just a quick question in the Q&A saying that I noticed you guys made a few changes to the Sonia and Eurodollar futures charts in your videos today. Why do they look different? Anything that we should know? So yes, you're right. We did make a few changes, but it's really nothing major. I'll quickly show you what we did. I just made a few changes because we often get a ton of questions on what exactly these contracts are, what they mean, how we should read them. And it can be a bit confusing to look at the contract price of these derivatives and know exactly what they mean. So let me go to another entirely different chart and just show you exactly what we did. So let's look at the way that it's normally presented. So let's just go to a Sonia futures contract. Let's just take the December one. So this is what they normally look like, right? And what we would normally have to do is we would normally have to go look at the contract price. We would need to take out a calculator. We would need to say 100, subtract the contract price, subtract the official bank rate, of course, and that gives us an implied rate of what Sonia Futures is implying from a tightening point of view for the Bank of England for December. 17 basis points of tightening, basically one interest rate hike. So that's what we normally had to do. Now, just to make that whole process a little bit more easier to understand, what I've basically done is I've already done that calculation instead of doing it manually. So I just went 100, subtract the actual Sonia futures contract, subtract the official bank rate, just pressing enter, and you'll see that basically inverts the chart because it now does that exact calculation that we just did, getting to 17 basis points. It automatically does that calculation for me. So now when we look at the Sonia futures chart, it's going to move up if interest rate expectations are moving up, and it's going to move down when interest rate expectations are moving down. Normally they would be inverse, and that just caused a lot of uncertainty and confusion when we did these videos. So I've basically just tried to take all of the equations, put that already into the chart. So when you look at this right now, it tells you, okay, for the December contract, the market is basically implying 17 basis points of tightening by December this year. So if we go back to those charts, what you'll notice there is that we have the exact same contract. We've got the December one. We've got the, let me just quickly think what the June one was. I think June is coming in an H. That's March. So we've got December this year, we've got March, we've got June, we've got September, then December, and then obviously looking at March 2023. So it's the exact same contracts that we normally looked at, but now we've just adjusted it, already did the calculation, already adjusted it for the cash rate or the bank rate, and that now on the right-hand side shows us the actual expected amount of tightening by the Bank of England. I did the exact same thing for the normal Eurodollar futures as well. So instead of showing a curve that runs like this, pushing to the downside, it now moves in line with interest rate expectations, moving in line with interest rate expectations to the downside, obviously, recently. And the values we're seeing here is the actual expected amount of tightening. Now, what you will also notice here is that I've also added in the Fed fund futures as well. Now, it basically shows us the exact same thing as the Eurodollar futures, but they are slightly different in their calculation. So, for example, the Fed fund futures, they settled against the average daily effective federal funds rate for that particular month, where if you compare that to the Eurodollar futures are determined by looking at the 3-month LIBOR rate. So there's always going to be a difference in the actual value. And because Eurodollar futures are settled based on that 3-month LIBOR, you also need to adjust it to account for the difference between the actual effective federal funds rate and that 3-month LIBOR. Where if you compare that to Fed fund futures, you don't have to do that, which is great. But at the same time, because the Fed doesn't target a fixed rate like other banks, instead they target that rate corridor, it does mean that the Fed fund futures often slightly underplay expectations for rate moves, which is why Eurodollar futures, even after adjusted, you'll see that it actually shows a slightly higher value. So, for example, if we take a look at let's quickly take a look at the December contract for next year. December contract for next year for Fed fund futures is sitting at 50 basis points of basically the a Fed funds rate of 50 basis points, so 2 hikes. And if we compare that to the December contract on the euro dollar futures, you'll see it's sitting at 64 basis points. So it's slightly higher compared to Fed fund futures. And remember, that is after adjusting, of course, already for that corridor rate. So there is some slight differences. Also keep in mind that given the way that they calculate it, and given that each of them is an interest rate derivative, they will also have different term premiums, which will distort the price and affect the way that they affect the actual implied rate. But they are very close to each other. They basically show us the exact same thing. But what I've done, and I've done the same thing, obviously for the Fed fund futures, we don't have to account for the actual Fed funds rate because it's already adjusted for that compared to euro dollar futures, which isn't. So just a couple of basic changes. In a nutshell, it'll now move in line with interest rate expectations. When they move up, it'll move up. When they move down, it'll move down. And instead of showing us a contract price, it'll basically just show us the actual amount of expected tightening for the likes of the SONIA as well as euro dollar futures when it comes to Fed fund futures, basically showing us an implied rate at that time. So still the exact same things, just already did that calculation for us automatically. So I hope that helps with the question. Any others, please don't hesitate to let us know.